This is our Forex blog for February 12th, 2013, and what I would like to go over is something I call event-based trading. And the way we do it is we use our individual currency indexes. This is the US dollar. I've created a chart of all the dollar pairs, kind of like other indexes like the Dow Jones, NASDAQ, Russell, S&P 500. And when you have indexes, you can see when they break out and make a higher high. You can see when trend lines are broken. You can see the orange or the gray line in the middle. When this is the hourly moving average, when that gets broken. And here's the point of control where most traders have positions at the previous day and the previous day's low. And I've put our containment bands on there because typically price is going to reverse when it gets to and sometimes slightly beyond the containment bands. You can see very shortly after, 15 minutes after it reversed, it came down to that level again, stalled out, and then reversed for hours. So basically you can buy the strongest currencies versus the weak and sell the weakest currencies versus the strong. Let's take a look at some of the other ones. The euro, when it went from underneath to above the hourly right here at 4 o'clock, and it went up to the upper containment bands, it's a very high probability to be going up. And especially when it went from below to above the previous day's high here, you might have got into a trade that made 5 to 15 pips here. The second time it busted through the previous day's high, you probably made 50 pips because it was a huge move. All you got to do is find a currency that's weak at 4 o'clock. Underneath it's hourly, trending down. We have a daily, weekly, monthly trend on it. Let's take a look. This one's weak, the pound. Swiss is strong. The CAD was weak at that time. So you could have simply, at that 4 o'clock, bought the Euro CAD. It's really that simple. 4 o'clock, we'll scroll back and look. Whoops. And here's 4 o'clock. And you can see when events happen on the indexes, it went from 34.80 all the way up to 60. It's an 80 pip move. Whether you more than likely got into this, and like I said, you might have made 5 to 15 pips on the first trade. I was wrong. You actually made about 20, 25. You buy this little pullback, you get long again, somewhere around 3,500 when it starts to go back up again, and that second trade went up 60 pips by simply finding a currency that's strong versus a weak one. The CAD, you can see it was already trending down. It's underneath this hourly, underneath the 15-minute moving average. Let's take a look at some of the other currencies. The pound broke down a little bit before 4 o'clock. So the euro pound would have also been an excellent one to be buying, especially at 4 o'clock and slightly even before 4 o'clock. The pound broke down a little bit earlier, so it would have been somewhere around this area. And even if you missed that initial trade, you have an opportunity to get into a beautiful pullback trade, and you just simply draw your fibs off of the first swing, and it tells you where your profit target is. 85.90 you're in at, and you're out at 27. That's a 37 pip move. And really, it's that simple. That's how you use our currency meter to find strong ones and weak ones. Here's the Australian. Notice it was underneath the hourly moving average all day. It had 2 false breakouts underneath the previous day's low. This one is very weak. The daily trend's down, the weekly trend down, the monthly trend's down. So ideally you would not want to buy this. However, anytime a currency proves that it's not weak enough to continue down when it breaks the previous day's low, and you have a nice little wedge pattern kind of right here, you can kind of ignore the brief move underneath that. The volatility is getting very small, and it finally breaks out somewhere around 9 o'clock. If you found a currency that was super weak at 9 o'clock and preferably had a weekly and monthly trend that was down as well, then you can kind of cancel out the longer term trends because they're both weak. Let's find which one was weak from around 9 o'clock. All right, this one's still going down, the pound. So when the Australian broke out at 9 o'clock, you could have sold the pound Australian at 9 o'clock, and you can see it probably fell from around 5,200 down to 60. It fell about 40 pips during that move. If you missed that first move, you sell the first pullback right here, you might have made 10 or 20 pips, and then a little bit later there was a few pips to be made as well. Let's see what else we might have traded at. So this one was weak at that time. At 9 o'clock it actually shot up. It just exploded up from below to above the hourly. In the perfect world, when you see this happen, look down at the longer term trend, and if the longer term trend is up, you definitely want to buy this currency versus one of the weakest ones. But let's try to find one that's weak at 9 o'clock to trade the yen against. This one's still weak, the pound. So that means the pound yen is a great one to be selling at 9 o'clock. And as you can see here, obviously this exploded down through the little wedge pattern here. If you missed that first trade, you had an opportunity less than a half an hour later at selling the pullback. You would have been short somewhere around, let's just round down to 33. And you can see it came down and pretty much double bottom down here. So that's an 80 pip move. And even if you sold this one right here, you had a chance to make 15 to 20 pips. And that's the power and the ease of using our indexes. At a glance, you can see, you know, our currency's making higher highs. In this case, no. This was in a very tiny rectangle pattern for a long time. And then it broke down from above to below the hourly, and it was a phenomenal trend. And you can see very easily on the chart that it made a slightly lower high right here. And so when it finally, you know, broke down again underneath these lows, if you give a currency a couple hours to go up and down, usually it's going to break out one way or the other. You don't know what the direction is, but the likely direction's down because the daily trend's down, the weekly trend's down, the monthly trend's down. The pound is weaker than it was all day yesterday because it went underneath the previous day's low, and it's at this point underneath the previous day's low. Pretty high probability trade there, coming up to 8. Let's take a look at the New Zealand. Good example of one that has a daily, weekly, monthly trend that's up. It tried to go over yesterday's high and failed, so you might have gone short it here for a small little scalp. You know you're going against a longer term trend, so you're probably only going to make 5 to 25 pips max. But when this fails to go lower right here, it tries to go lower and comes right back up, and then goes sideways and breaks out from below to above the hourly, and especially when it breaks above and makes higher highs than it did all day yesterday. All the trends are up, the intensity of the trend's up. You want to find one that's weak at 9 to trade this against. That's it. Let's find a weak one at 9. This one went from above to below the hourly at 9. So you could have bought the New Zealand Swiss with a high degree of certainty. Probably going to make 30 to 50 pips on this at 9 o'clock. So here's 9 o'clock. And most of these, using this tool the way I'm showing, most trades are 30 to 50 pips in my trading experience. You can see it went up 10, 20, 30, 40, 50, 57 pips from there. And more than likely, I would have got in this trade and it kind of looked like it was fizzling out. I would have probably got out of that trade with maybe 8 to 10 pips, and then bought this next trade here, had my fib level already set, and if it's super strong, it's likely to go up to the second fib target. If it's not, typically I get out of half my trade here, and then if it works its way up, I get out of the second half here. So I would have probably averaged somewhere around 77.26. This last trade we're in at 10. That's a 16 pip move. Maybe we would have made 15 pips on the first one. I prefer to get in and out unless the trade is clearly going my way the whole time. But that's how you use this currency meter. It's very easy, and you know, when you see earlier today the Swiss, you can see the weekly trends down, the monthly trends up. It's been going sideways and it's not able to break out through the lows. It wasn't even able to go down to yesterday's low, so it's just going sideways. It's not weak, it's not strong. Whatever way it breaks out is what you trade it. The weekly trends down, the monthly trends up, breaks out right here. Very high probability trade at 330. If you find one that's super weak at 330, the dollar isn't at that time. Pound's weak at that time. So the pound Swiss is an excellent one to be selling because the pound is getting extremely weak. At the same time, the Swiss is getting extremely strong. This is a no-brainer. It's probably went over 50 pips. When that happens, you're typically going to make 50 plus pips. And guess what? 330 is right here. It's already started to inch its way down a little bit. Let's say you got in a little bit late at 43.90, came all the way down to 43. So like I said, you made 90 pips. And that's what happens when two currencies are exploding at the same time. When one currency is exploding, the other one's just slightly weak or slightly strong, you tend to make 25 to 50 pips. So it's a good rule of thumb. It's worth taking a risk on these kind of trades. I call it event-based trading. It's something brand new. We just released these indexes. It's by far the best tool we've ever released because it's so easy and people can learn to trade Forex in 2 to 5 minutes watching these videos and be able to spot these trades because there's only a couple things you look for. You know, a little sideways rectangle breakout, when it breaks from underneath above the hourly, preferably with a longer term trend in that direction, you're going to make more pips typically.